anticipated impact of current tariffs, but it does not affect future tariffs.
Get some shit here.
Morgan.
All right, I'll take it. Thank you. Gross dropping on earnings. Mackenzie follows. Why?
The block reporting adjusted earnings of 56 cents a share, John, up 19% from a year ago, but that's not comparable to estimates due to a change in stock-based compensation accounting. Revenue a big miss, 5.77 billion versus 6.2 billion expected. Gross payment volume, money moving through Square and Cash App came in light at 56.8 billion, though it is a profit beat on EBITDA. Now, Cash App gross profit was a bit softer than expected. CFO Amrita.
Roku also announcing the purchase of service provider Friendly TV.
As its borrow product expands nationwide with FDA approval. Looking ahead, Block is cutting its full-year gross profit guidance, citing macro uncertainty. Those shares down 12% in after-hours trading. Back to you. All right, Mackenzie, thank you. We've got Roku and Reddit earnings out as well. Julia Borson has the numbers on both. Julia.
Hey, Morgan, let's start with Roku. Top and bottom line results better than expected. Revenue 1.2 billion ahead of 1 billion estimates. Shares up about 2.5% on this news. Loss of 19 cents per share, better than the 27-cent loss per share analysts anticipated. For the second quarter, the company guided to revenues of 1.07 billion, roughly in line with expectations, and adjusted EBITDA of 70 million, which is below the 76 million, which is the street account estimate. The company also reaffirming its full-year adjusted EBITDA guidance. Now, as for economic uncertainty, Roku saying, quote, while tariff-related impacts to our devices segment remain difficult to predict, we expect devices revenue and gross profit loss to remain consistent with 2024 levels. Roku also announcing an acquisition. It's buying Friendly TV, a subscription streaming service with over 50 live TV channels. Now, shifting gears over to Reddit. Reddit beating on the top and bottom lines. Shares up 17% in after-hours trading. Revenues of 392 million, topping estimates of 370 million. Earnings of 13 cents per share, far ahead of the 2 cent per share estimates. The company reporting daily active uniques, 108.1 million, slightly ahead of estimates. And Reddit also guiding to stronger than expected second quarter revenue to a range of 410 million to 430 million, ahead of the consensus estimate of 396 million. I spoke to CEO Steve Huffman, who told me, quote, we're carrying momentum into Q2. This quarter is looking solid. It's hard for anybody to predict beyond that, but we've grown in uncertainty before. We are confident that we could do it again. He also spoke to the improvement that they've seen from their ad tech investments, the value they see in Reddit.
Global Solutions, 42.5 billion in revenue, about in line with expectations. At Michael's here, India, $3.18 for earnings is a 17-cent beat for MSI.
Trends or some of these other names as well.
What do you do with it?
Yeah, so I mean, pretty much every major participant in the travel leisure industry has acknowledged softness in the U.S. Going back to March with the airlines that were kind of the first ones out of the gate. Then we've heard from hotel companies, even Norwegian Cruise acknowledging this. So not really acknowledging softness in the travel market. Again, that's kind of very consistent with what everyone else in the space had talked about. Lots of them are interesting. We've heard from Visa and MasterCard, the company that really have the best forward for spending, and they see things as so resilient in terms of spending. But some of these more specialized companies, such as Block, have been a little bit more mixed this earnings season. Obviously, there's disagreement on the Square part of the business. And then for Reddit, I think Snap raised some concerns about some of these smaller social media needs, but obviously Reddit continues to perform very well.
So just a reminder what's happening there. They're reporting their second quarter.
Well, there's more. Trillion jumping 8.9% year over time.
Second quarter earnings 135 EPS of $62 and a revenue estimate of $94.62 billion.
The street had been looking for 94 cents. Revenues came in at 1.17 billion. That was well above the 1.14
Reminder
billion.
there to at about
In the com segment,
4:30
revenues were 1 billion. That was up 13%, which was better than the overall revenue growth. Kusina Chandler, the CEO, saying he's encouraged by momentum to start the year. As far as the second quarter guidance,
It's a little bit shy potentially in terms of what the street is looking for on the bottom line. The estimate is for $1.04. The company is guiding between 99 cents to $1.04, but on the top line, they're saying $1.18 billion to 1.9 billion, and the street was looking for 1.17 billion. But you can see, and they seem to like what they saw. Shares now up about 7.75%. All right, Bertha, thank you. And we're about to hear a lot more about that because Twilio CEO Chip Chandler is going to break down those numbers and more with us exclusively before he dials into the call with analysts. Stephanie, I want to go back to you. There's a number of things that we could talk about, but I want to start with the biggest move here, which I think is Reddit. The stock has been down quite a bit, but these beats are a little bit eyebrow raising, I'd say.
Big Bear AI, BPAI reporting 34.8 million in revenue for the quarter, missing a 36 million consensus from Alpha India. Big Bear firming guidance for the year.
What's your takeaway so far from this earnings season? And I say this knowing that we're Thursday into what is the busiest week of earnings season, and we've heard from most of the Mag 7 names now, starting on Apple a little bit later this hour, and of course NVIDIA in a couple of weeks here. But what's your takeaway on what we're seeing across different industries?
I think it's a very strong earnings season, especially versus expectations earlier in the month. Companies are performing very well. They're managing through the tariff uncertainty for the most part. You obviously have some exceptions of companies getting hit very hard, but they're pulling a variety of levers, whether it's price hikes, cost cutting, supply chain adjustments, and you're seeing a lot of upside in Q1, but you're also seeing for the
AIG reporting just earnings $1.17, being one of 5 consensus. Alpha India Gulf. Strong top line growth with net premiums written of $4.5 billion, flat year over year for AIG. These are homes BZH 42 cents for earnings, beating the 26-cent consensus. Bravo Zulu Hotel.
Okay, Adam and Steph, we'll see you both later in the show. Thank you for kicking off this earnings parade with us with all the major averages finishing higher. The S&P finishing just above 56.
These are revenues beating expectation of $565 million versus the $543 consensus for BZH.
U.S. Steel loss of 39 cents, better than the loss of 48 cents expected.
Much more on Amazon's print as that stock bounces off the overtime lows, now down just about 2.5%. Get some more details from the release as well. Overtime back in June.
What's up, everybody?
CYTK FDA extending PFA action date for treatment patients with OHCM to December 26th, pushing it back 3 months for Charlie Yankee Tango Kilo.
All right, what I'm going to do, I'm going to go through some stuff over here. I know Apple reports bottom of the hour. So, you guys talk amongst yourselves, chit-chat about Apple, do what you got to do. But I'll run through some of the indicators, catch everybody up to date here. And kind of what we see going forward, especially after this rally over the past week or so. Hold on, let me mute this guy now. All right, hold on 1 second. Apple's got to wait till 4:30 and be different. What'd I do with my phone? Dang it. There's no way I took the phone. All right. So you got Amazon down a little bit in the after hours. All right. So if you rewind, I don't think we met on this webinar last Thursday. I think I had to cancel. But regardless, if you rewind a couple of weeks back, we had a discussion that a lot of the signals we like to look at in market corrections were lining up pretty bullish, right? And I gave you guys the example that very similar to the 2022 summer low. If you remember, we had the discussion where at the least we should see some sort of floor be put in, even though we can't really make the case for the start of a new bull market or a new bull trend, right? That's how extreme a lot of the indicators and signals that we pay attention to got to the point where they got really extreme, very similar to what we were seeing, is what I'm saying, to the summer 2022 lows. Obviously, tariffs, threat of recession, whatever cockamamie reasoning and excuse behind it, there was a lot of fear out there. We started to see some panic, started to see capitulation. So exactly what we wanted to see during this pullback, okay? So again, it's important to understand that even though there's a high probability floor put in, it doesn't necessarily mean the start of a new risk-on bull trend. And if you're wondering what the big difference is there, you can have kind of what we saw here, a pretty healthy and violent squeeze over the course of a couple days, right? Especially if you get some good news in the mix. Funds don't have exposure because they obviously shed a lot of exposure in the pullback, and they scramble and chase to put on exposure. Sometimes it can lead to a choppier environment where you get squeezes in between. But because of that lack of positive news on the macro front, or even more so, a lack of appetite, right? A lack of appetite from buyers because you really don't have that catalyst via macro, the Fed pivot, not there yet, right? So that's why we kind of were making the case that even looking at it conservatively, and we got it circled here from when we were looking at it, we could make the argument that we're kind of at a spot like this, right? And what's interesting is that, no one had, and this is where, it gets kind of annoying, and I hope you guys feel the same, with these predictions out there, right? Anybody who's making a prediction and has conviction behind that prediction is full of shit, right? Because you don't know what's going to show up a month, 2 months, 3 months down the line, right? We don't know when that Fed pivot, if that Fed pivot's going to show up, right? That's a big difference. That's a huge impact on whether scenario A or scenario B plays out, right? So the reason why I was bringing up the summer 2022 lows as an example is that not that I feel with confidence that we're going to retest those lows and breach it like we did in the 20. I have no idea, right? But at the least, because of how bearish people, funds and players had become, right? Because of how much they have de-risked and how aggressively the flows have flipped. And we'll talk about that in a second if you guys are around a couple of weeks. Because of the bullish flip and flows, there was a higher probability of buying into additional weakness than further selling, right? So that's where that floor kind of gets put in, all right? Now, ultimately, okay, what we want to see play out is what we're seeing right now. Do we get an aggressive squeeze? Do those bears flip to bullish, right? That's what we need to pay attention to kind of get an idea of what the short-term future may look like, right? You can't predict how that's going to shake out. All right, so we'll spend some time and talk about that today. Now that we had a low put in and pretty decent rally thanks to last week and the front end of this week. How does positioning and sentiment look like now, and to get a better idea of what the short term may look like from this point? Okay. What's interesting is, again, going back to the 2022 summer lows, we actually, from just an eyeball test, it looks like we actually even got further extended off this rally. Right? And you can see here you had upside niners, you had a little congestion and some more upside. So that's still a possibility that we can overshoot to the upside, especially if players and funds are kind of remain in that non-believer camp. But you have a lot of exogenous stuff out there, right? You have macro data, earnings. You got a lot of other things that come into play. And that's why you got to reevaluate with all that information. Okay, so let's take a look at where we're at now, right? You can make the argument, again, using that 2022 summer low as an example, we're somewhere in this vicinity. Now, what we want to see is, based on how much we've rallied, have people become bullish? And from what I'm seeing, okay, they really, big picture wise, they have not. And let's take a peek, right? So let's go by this so I don't confuse everybody. Here's kind of the negative we have to deal with right now, right? If you're bullish at heart and you were looking for a floor, but you don't, you come to the conclusion, like I mentioned, that this is not the start of a bull trend. It's more of a sentiment squeeze than anything else. You really don't want to see what took place here. You don't want to see an exaggerated upside move, right? Because the further you get from those lows, you got a lot of air in between now, right? If we kind of bounce around those lows, rally for a few days, chop around, you can play off that sentiment and that positioning off those lows and use that to our advantage. Now, like, we could shed 4 or 5% here, and it really means nothing. Okay, so being a bull at heart, and that's what I am, you don't want to see what we just saw and the rally get too aggressive and overextend like we have seen. We don't have a choice in the matter, but I'm saying if we had a choice. Okay, so the negative is that we've come a long way, right? And a lot of the internals and breadth measures, a lot of that stuff, especially on a short-term basis, that was really, really wrung out. And again, one of the reasons why there was a high probability of some sort of floor being put in, okay, a lot of those shorter term timeframes have flipped now, okay, because of how violent this snapback has been. And you can see that here, right? When we looked at it, if you remember, across all time frames, this was lit up green, the whole entire board, bright green, right? So now not only have you lost some of the green, still some there, longer term, right? But not only have we lost some of the shorter term green out there, you got some red showing up. Okay, just telling us that we're kind of came too far too fast in a sense. All right, so that's one of the negative things out there right now. Another thing that I look at as somewhat negative, even though I didn't believe this was a start of a new bull market and bull trend. We talk about the credit market signals, right? We want to see credit market signals confirm the start of a new bull trend, right? Or a new bull market. And the credit market signals we pay attention to have not confirmed that this is anything more than just a sentiment squeeze, right? Players, funds capitulating, puking up long positions. Now you get some good news on the tariff front. You get good news out of Meta and Microsoft yesterday, and they're scrambling to re-risk, put some of that exposure back on. Okay, even though it may not be much big picture wise, you still get that scramble, right? So that's kind of what we've witnessed, more so than the market going higher based on buyers bullish on the macro end or bullish off the Fed flipping, right? That's not, in my opinion, that's not what we're seeing. Okay, we're seeing solely the characteristics of a sentiment squeeze and what you usually see when sentiment gets that wrung out. So the credit market signals to this point today have not confirmed that this is a risk-on move. You get a Fed pivot, the next Fed meeting, which is next week, I think, that can obviously change things. Okay, but to this point, we haven't seen that. Okay, so that's another, again, if you want to put it in the negative column. Here you can see the divergence in corporate bond yield spreads. I mean, pretty significant divergence on a shorter term time frame. Okay, you can see the market kind of S&P 500 pushing higher, and this is inverted. So you would want to see this pushing higher with it. The more aggressive, that means spreads are tightening, and you got a risk-on backdrop. Okay, you can see they kind of stalled out here, even as equities have pushed higher. All right, and again, that's not that surprising. Like today, in my opinion, was a complete mirage. You had Microsoft up 10%, right, carrying a lot of the mega cap names that are heavily weighted up with it. You had the equal weight S&P 500 flat to down today. All right, so today wasn't a risk-on rally by no means, and that's kind of what these credit market signals are indicating. All right, so that's another negative. Here, short-term sentiment signals, right? Again, a short-term time frame. They were bullish and laid pretty much on bull signal for a bit as we saw some selling and capitulation, whatever you want to call it. Now you can see how we swung all the way to the other end, right? So here you had a reading of 0, which is really, really rare. And now you swung over 60 into that 60-70 range. Again, just an indication on a short-term basis that we're overshooting here. Okay. Now let's get into the good news, right? So I just want everybody to understand what I've just showed here, and a lot of it, for the most part, you could call it negative, okay, or some caution, is strictly short-term, in my opinion. Okay, even kind of the credit market signals, they are just telling us that this rally has been more about a squeeze than anything else. All right, and with that information, you want to be careful chasing late in the squeeze. Okay, so all the stuff that kind of is flashing a little bit of caution that I just showed you is all short-term on a short-term time frame. Okay, bigger picture wise. And again, the bigger picture stuff is what really lined up that floor that we were discussing, okay? It's still in really, really good shape, okay? You have the hedge fund crowd. They have spit on this rally. They want nothing to do with it, all right? So hedge funds have put back on very little risk, net, okay? So that's a very good sign, right? They haven't flipped from cautious to bullish. The systematic fund crowd, and if you ask me, this is a big part of what we're seeing. Okay, if you remember, getting the max short is such a luxury because when you get these systematic funds to a max short level, okay, even if there's additional weakness, they become buyers now into weakness, right? because they are kind of capped out. They have as much short exposure as they're going to have at this current time. So into any additional selling, these funds are likely going to take off some of that short exposure. If you get any sort of relief out of the VIX, which some of these things are tied, or break some levels on the upside in the S&P, they become buyers, right? So you got buyers into weakness, buyers into strength. That's obviously a bid in the market that we didn't have throughout the correction, right? And what this is showing here, even globally, because you had some of the European markets holding up better. You remember they were kind of stubborn. They were the last to go. Even globally, you have systematic funds aggressively short. Okay, and that led to this over the last 2 weeks, right? And this is what I just mentioned. This is from Goldman. According to their model, coming into this week in a flat tape, right? So a market does nothing. They're buyers and pretty decent size, right? 7 billion in the U.S. In an up tape, they're obviously going to chase, right? 12 billion in the U.S. In a down tape, where they've been doing nothing but selling since we started to roll over in equities, they also become buyers, right? 4 billion into weakness. And that's the big change, right? So no matter what the equity markets do, the systematic fund crowd that has been aggressive sellers now do some buying. Okay? We'll see based off this week's rally how much of this changes going into next week. Okay? But, this has been the case for a couple of weeks now. Here is strictly just CTAs, right? Just that trend following crowd in equities. Again, we looked at this, but you can see a very minor bounce so far. Again, we'll get a better look at it over the weekend when some of these things update. But max short and a little bit of relief there. This is what Mick Elliott keeps harping on, right? So these are just vol control funds, right? They strictly trade off what the VIX is doing. And you can see down here, now I don't want to get too wonky with all these numbers on here, but vol control funds, right, coming into the year were loaded up in equities, right, because of VIX. And if the momentum started to crack and roll over, you got a lot of de-risking to do, right, from this crowd. Now we're all the way down here, right? And the same thing applies to them. Even if, when they're down there, even if the equity markets are down pre-market 3% and you're getting a VIX pop, they're more inclined to do some covering than adding more of that bearish exposure. Okay? So, again, this is pretty up to date from Mick Elliott out of Nomura. But, again, just lines up with all that whole systematic crowd. Another buyer that has entered the picture here, and the markets love to front run, are buybacks. All right? You may not think it's a big deal. Buybacks have been the biggest buyer of equities, feels like forever now. Right? Institutions really haven't been a big buyer of equities in a long time. All right? So buybacks have been the buyer. Okay? They go into blackout because of earnings season. So as the market feels like it's crashing off of Liberation Day, all right, you don't have that buyback bid. And now, if you remember, we were talking about towards the end of April, as we get later into April, that buyback window starts to little by little open. Okay, and you're getting more and more buyback authorizations, right? And the market likes to front run this anyway, right? It's not like you get a buyback and then the market goes up. This is public information. Like we're talking about it, other institutions, other players are talking about it, right? So they like to front run this even before it actually happens, and that's what we've been seeing. Okay, what else we got here? These are funding spreads, right? So this is a good indication of how much leverage some of the smarter money is pumping or pulling out of the system. You remember we had the discussion coming into this year that they aggressively de-risked, and that's that red line diverging here, right, in a pretty meaningful way. It kind of stabilized here, right? So they're not deleveraging any further, but at the same time, now that we got a little relief here, what you would want to see is you want to see them start to pump some juice back into their game, right? And they haven't done so. Okay? So again, probably what it tells us is they're probably waiting on something, right? More than likely, it's probably a more accommodative Fed, I gotta believe. All right? So they haven't pumped it up yet on their end. Sharpies, commercial hedgers. This was again notably bullish. This is just the S&P 500, and you can see they were aggressively hedged into the highs. Right? As the market came in, they decided over the last couple of weeks, as things got a little panicky, to take off that whole entire hedge, basically. Okay? Ideally, what we want to see is you want to see something like this, right? You want to see them not only remove that hedge, but now get aggressive on the long side. Okay? You probably need a little more of that positioning for that to happen, because that's their catalyst. They take the other side of hedge funds and retail. But again, this was the summer of 2022. Okay. And then this was, I think, the SIVB crisis, all right, where they took the opposite side of both. Okay. So we would like to see this, and it's probably going to happen into weakness more than likely. We would like to see them as well get aggressive from this point. Okay. But even where it was, right, taking off that aggressive hedge that they had on was a big start. Right? They felt that they no longer needed to be as hedged as they were. And reason being, things were overdone on the bearish side. Okay? So we'll see how this plays out going forward. Wait. Oh, yeah. I just showed up. Oh, I posted it twice? No. I got a couple more here because we didn't meet that last week. I just, some of the more important stuff. This is retail put buying. Okay? If you remember, again, rewind to when the market started to pull back, what was rubbing us the wrong way is you had retail call buying showing exuberance, right? They're just coming off buying zero revenue small cap stocks all over the yard. Okay? This is retail put buying showing that into that liberation sell-off, Liberation Day sell-off, they got aggressive speculating on puts. Okay, and that's exactly what you want to see into a low. Okay, so here what I'm showing is coming into this week, this is a weekly indicator, this is still elevated. Okay, coming into this week, even with the rally that we saw prior, this was still elevated. Okay, so that's a bullish sign. Again, we'll see, next week, the update based on this week when it updates. And the last one I got here is same thesis, positioning. These are the Ridex funds. Okay, and what they do when they're feeling giddy, they get into levered bullish funds. They move money, right? So fund managers, when they feel bullish, they rotate money into bullish funds. When they get skittish, they rotate money into bearish funds. When they're panicky, they buy those bearish funds aggressively. And what this is showing is they bought those bearish funds aggressively into the lows a couple of weeks ago. All right? So a lot of times what you see here, even if it's not the start of a bull trend, a lot of times you see this unwind before a market would starts to sell again in an aggressive manner. Okay? Not always, but a lot of times. Right? You can see even throughout the 2022 bear market, with the Fed rigging the game, you had spikes in this reading, and every time there was a spike, you got a squeeze, and then after the squeeze, they unwound, right? Because they weren't feeling as bearish anymore. They unwound that position numerous times, right? Here was the summer low, and here's the fall low. And that we talked about, right? Yeah. All right. So net, here's the scoop. Okay, and I just want to again, I don't want you guys to think I'm looking. I got some crystal ball in between my butt cheeks, and I'm using that to make forecast and predictions here, right? Based off what we were seeing a couple weeks ago and where they are now, right? And we're going to get some updates over the weekend because of the rally this week. On a short-term basis, okay, obviously it's not as appealing right now, risk-reward wise. Okay, can we overshoot to the upside? We sure can. All right, I showed you a lot of the reasons why. Okay, but on a risk-reward, from a risk-reward point of view here on a short-term time frame, you really want to be careful, especially with earnings and some of the macro data maybe worsening here. You got the Fed in play. There's some room now, right, between here and those lows where some selling can enter the mix. But at the same time, I think we need to look at sell-offs as an opportunity to get long. Okay? And not only that, it's likely, okay, and this is where we can take a little more tactical view, pay attention to the news, why the market may be selling on a particular day, knowing that players are still and funds are still bearish and underexposed. It's going to be really, really difficult to get some selling to stick. Okay? In other words, they're going to need some help from on the macro end or Trump tariff. They're going to need a catalyst to really get that momentum shifting back to the downside while they're still this skittish. Okay, and that's where I think we can also use that to our advantage, and on a more tactical, from a more tactical point of view. Right? Example: when was it? Not yesterday, maybe the day before yesterday. The markets were gapping lower on some Trump nonsense and economic data, and you could just sense that sellers really didn't have much. So you're going to get. It's going to be a lot stickier out there. Right? You're going to get a lot. What I think we're going to see at some point here, once this squeeze kind of runs its course, you're going to get a stickier tape. Right? You're going to get a tape where you're going to get fades off any strength because we're overshooting to the upside and come so far, right? Where we need to digest. But the selling, right, because of how buried up everybody still is and looking to short and capitalize off that selling, you're going to get a lot of squeezes as well. So it's almost kind of like a mean reversion, sticky type tape that we're more inclined to seeing. The wild card here is kind of what we're dealing with, right? You got earnings, you got, all sorts of things going on, right? If you get a positive reaction to earnings, more than likely after hours, you're going to be higher, right? Especially where some of these flows really don't have an impact, right? So we could see after hours selling, after hours strength, but in all likelihood, you're going to see fades and reversals more so, in my opinion, based on how things are lined up here. All right. So I hope I didn't confuse anybody out there. Short term, again, you want to look at it more as a kind of a sticky tape, and be a little more tactical, but on a more, I would say, intermediate, longer term time horizon right now, in my opinion, while the positioning stuff remains where they are, you want to use that opportunity. You want to take advantage of weakness with some time. Okay. And, again, we talk, I personally like to look at prior cycles, not because they resemble them identically, okay, but just to get an understanding of, because what you have, and think about this, right? Whether you're in a chat room on Twitter, every update, everybody's bullish, nothing, no bad will ever happen again. Don't worry about tariffs, the Fed, macro data. Everything's beautiful. And then on a down day, when stocks sell aggressively, you got 1929 charts and S&P 3000 forecast all over the place. So you kind of want to get away from that noise, right? Take a step back and look at things from a larger, big picture point of view. Okay, and looking at these prior cycles, it kind of reminds you of what you had to deal with when you were in prior corrections in equities, right? So in kind of 2022, if we say, like, even the summer low as an example, you had a really violent move. I mean, it came all the way back down and tested those lows again, right? Ultimately to bottom there, rally again, then another round of selling. You have ample opportunity to try to take advantage of weakness and look for, potentially new leaders, new sectors with some time. All right, so that's what I'm trying to do. I'm really trying to slow things down, not get too caught up in the rental action, in the Tesla arguments of the world, the Max 7 arguments of the world, any of that stuff. I want to look for clues of what the other side of this may look like. And the only way I'm going to get that information is by keeping my head clean and keeping my eyes open and having an open mind about things. But it takes time, right? In reality, it's not a lot of time, but when you're looking at every tick and you're trying to measure and find an excuse for every rip and sell-off, it feels like an eternity. It feels like an eternity. And don't get me wrong, right? I day trade just like you guys do, and I just think now you still could participate in that, but now you really want to focus on kind of the bigger money that may be at play, and that bigger money is always building positions and potentially new leaders of a new bull trend that may emerge. So that's kind of what I'm focused on here. All right. And again, earnings season, right? You're going to get some decent information out of earnings as well. For me, like, Microsoft doesn't really give me anything I need to know. What you're going to see is more of these under the hood type names in different sectors. Some of these tariff exposed names, maybe they sell them initially and maybe they aggressively get bought up. So we kind of want to look for those type of clues and not get tied up into what Microsoft or Apple may be doing off earnings. At least I don't. All right. Because here's where we stand right now, right? If you kind of look at the landscape, we have a market that has corrected, right? Positioning, no doubt, is so much cleaner, right? You could tell I feel a hell of a lot better about things than I did coming into the year, okay? But at the same time, you don't have a cheap market. You don't really have any growth to get excited about. And the only way to look through that more than that is usually the Fed, right? The Fed will get you to look through that. All right. So that's kind of what we're dealing with right now. And until the Fed does, you're more likely to get that stickier range bound trade net, even though it can feel like a bull market for 1 week and a bear market the next. So we'll see how that goes. All right. Anybody have any questions? Something I forgot to mention we usually look at, or anything like that before I let you go to enjoy your earnings season here? Name-wise, again, I didn't bring up names at all here because we're still early in the earnings season. There are definitely, we spoke about some names that a lot of us have an interest in longer term, right? Maybe you want to take a nibble. Well, again, 2 weeks ago was a lot better than where we are now, but it was totally fine if you wanted to start nibbling a couple of weeks ago, and then wait for some flow post earnings or whatever the case. But out of the flow, we really haven't seen a whole lot. A few of the repeat names, in other words, names that sweepers have been committed to, are still seeing any of the clean buying out there. I'll give you an example. This GLNG, they didn't report yet though, but this name's still catching pretty decent action. You had quite the recovery here already though. This one, which I own, which is a slower name, K-View. They're Tylenol and all. You got a few activists involved there trying to get things moving. What's another name I just was? EQT. Right? These are all names we had talked about in the past. They're seeing some repeat activity, repeat buying post earnings. So, but we're still early. With the RBRK, good call. RBRK, that's another one. The bad part so far is a couple of these names I already mentioned are names I already own, and I don't really want to add up here now, right, and ruin my cost at all. But RBRK has seen some decent repeat buying over the last couple of weeks. A little more bull flow today, post earnings. And I'm talking strictly here post earnings, right? Because everything is seeing earnings flow. Everything. You know what I mean? You name a stock that's getting ready to report, and it saw some sort of call action, put action. Everything. Especially when positioning is as empty as it is right now. Like an ARM, for example. Seeing some decent 2027 leap buying again. I think 2026 as well. But you have earnings, right? You have earnings there. So if this does come in because the market's a big sticky and you're through earnings and you see some of that flow show up, or even maybe even need to see that flow show up, you're convinced already. You take advantage of that weakness and start plucking away. All right. The other thing too, right? We talk about a lot on this webinar, new names. We're not seeing any signs of that yet at all. Not that we thought we would at the start of earnings season, nonetheless. But we haven't seen any signs of aggressive buying in any new names. We've seen some nibbling. I think I mentioned this to you guys. This Byrn, BYRN. There was some buying in December calls, stuff like that. But we really haven't seen anything new yet. But I'm convinced we will. All right. Anybody? Did I miss anybody? A question or anything? So again, take it easy. All right. Relax. Try not to get caught in all the hoopla and what everybody's talking about and the day-to-day gyrations or even the week-to-week gyrations. But again, I can only share with you what I'm seeing. All right. What we've seen on the positioning and sentiment side of things is really, really constructive. Right? Again, not today, 2 weeks ago, right? we've seen signals that we usually see at major lows. Okay, if we can avoid a calamity, then in all likelihood, it's going to set up an unbelievable platform and entry for any potential new bull trend that shows up. Just it doesn't have to show up right away. It could take time. So, yeah, again, I'm not, initially at the start of the correction, I was kind of into the tariffs and the macro data. I'm honestly right now, I'm not even paying attention to, not that I'm not paying attention, I'm not concerning myself with any of this stuff, tariff wise, macro wise. Okay, why? Because positioning is wiped out. Understand? When positioning is full, I'm concerned about that stuff because if something cracks, you got a shitload of selling that can really send things into a tizzy. Now with positioning in the shape it's in, let the macro data weaken. I think that ends up being bullish because it'll bring the Fed in. Let Trump talk tough again with tariffs and create some volatility. All right, because again, I'm looking at it through the point of view that selling can create an opportunity. All right, I feel a lot better about buying weakness and pullbacks here than chasing strength off negative news. Here you kind of had the opposite here, right? Because positioning and sentiment was so wiped out, the macro data has come in soft, and the market has rallied through it. All right, they're trying to front run the Fed here, in a sense, the market, and you get the Fed next week. But if the Fed don't participate, all right, that's kind of what you had in 2022, that summer low. You end up not only you retrace that whole entire rip and retested the lows, actually breached it. Right now, all we've done is we kind of got back to the Liberation Day crash, right? But at the same time, you had a full cleansing on the positioning end. So that's pretty constructive if you ask me. Here's again, the 2022 lows was this year, right? So even like what we rallied now, we're barely here. Again, just eyeball test, right? So we overshot quite significantly. But in reality, you still had lower highs, right? So in the heat of the moment, it can feel quite bullish. But the best part of that ended up being this. Right? That was the best part of it because that gave you another opportunity to get things at better spots and find some more names to tuck away if that was your game plan then. So the day-to-day macro data and price action, I'm trying not to get too caught up in because in my opinion, it really doesn't matter. It really doesn't matter. Apple came out. Apple, a little bit of weakness. Yeah. And Amazon was weak too. And the other thing about these names, and listen, the disclaimer here, because this is kind of what got in my way in 2022. Full disclosure here, full honesty. But in reality, if these are the names that are going to lead, okay, that's a defensive rally. That's not the risk on rally I'm looking for and hoping that comes out of this. Right? So, these names don't really, in my opinion, without the Fed, I just can't see these names, ripping to new highs and going. These mega caps, I just can't. I can see them hanging around here, but without the Fed doing their thing in the current backdrop, I can't see it. But honestly, I don't. It's not. I'm not. Put it this way: I'm not buying Amazon, Apple, or Microsoft. Let's be honest. You guys know that about me. No matter what, I'm not buying it. I own Meta as an investment longer term. I'm not. But these are not the names I'm looking for out of this correction. So these earnings, the last 2 days of earnings, I don't think really matter much to what we're looking at here. You rather than be negative, right? Away on sentiment more, I think. If you're looking for a true risk-on new bull trend to emerge from here, you're going to see a lot more names than Meta and Microsoft. Okay? All right, my friends. All right, so again, big picture-wise, a lot of good. On a short-term basis, honestly, we can do either way, especially with earnings in the mix. But I think the most important thing is to keep our eyes open, especially post-earnings, for some clues of potential new leadership or new sectors, subsectors, new names. And, obviously that post-earnings flow. See if they start accumulating anything, right, under the hood. Okay, so don't get caught up in the noise too much here. Yep, see, he'll be good, Chambers. Everybody, enjoy the rest of your night. And I'll see most of you mañana. Be good, everybody.